Welcome to Informed Investor. Let's dive into the latest news in global finance that's causing quite a stir. Japan has made a significant move by ending its long-standing practice of offering negative interest rates. This decision by the Bank of Japan to raise its key interest rates from minus 0.1% to a range of 0 to 0.1% marks a notable shift, especially because it's the first interest rate hike since 2007. To really grasp the significance of this development, it's important to understand the relationship between interest rates and inflation. When we talk about central banks like the RBI, the Federal Reserve in the US, or the Bank of Japan, one of their primary tools for managing the economy is through adjusting interest rates. When they raise interest rates, borrowing money becomes more expensive, which tends to reduce the overall money supply in the economy and consequently brings down inflation. Conversely, lowering interest rates makes borrowing cheaper, which stimulates economic activity and can help combat deflationary pressures. Globally as well, as we all know, countries have been dealing with the challenge of inflation, which is essentially the rise in prices of goods and services. Adjusting interest rates is a common tactic used by central banks to manage inflation. By raising interest rates, they aim to curb demand in the economy, thus bringing down inflation. But Japan was an exception. Now, let's shift our focus to the Japanese economy. When discussing Japan's economic landscape, you might come across the term Japan lost decades. This term refers to the period of sluggish economic growth that followed the collapse of Japan's asset price bubble in the early 1990s. It's a term that emerged in the late 1990s, reflecting a stark contrast to Japan's previous economic success story. Though we won't delve too deep into the intricacies of this period, it's important to note that the lost decade was categorized by economic stagnation and persistent deflation. Inflation has remained notably low in Japan since the 1990s. Currently, inflation, after being low for years, has sped up, cemented by larger than usual increases in wages. Japan's inflation rate stands at 2.2%, which exceeds the central bank's target of 2%. This context is crucial in understanding the significance of Japan's recent decision to raise the interest rates. Now, why is the Bank of Japan's decision to raise interest rates significant? Well, it's a big deal because until now, the Bank of Japan was the only major central bank in the world using negative interest rates. By raising interest rates, it suggests that they might be changing their approach to managing the economy. Now, what does this mean for the global economy? While the actual change in rates might seem small, they've gone from minus 0.1% to just about zero. It's more about what it represents. It marks a departure from a prolonged period of deflation and signals the Bank of Japan's response to a resurgence in inflation. Japan is a huge player in global finance with lots of money invested abroad. If Japanese investors start moving their money back home because of the better returns, it could shake up markets worldwide. So while this move might not directly impact places like India right away, it's definitely something to keep an eye on as it could affect how money flows around the world. Having said that, this is me, Allison, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment related documents carefully. Visit www.researchandranking.com